Today's video about Intel could easily be an I told you so video. I told you that AMD's products were better than Intel's. I told you when Apple decided to start making their own silicon using an ARM design that it would be better than Intel's design. I told you guys so many times that you can't just come here and look at a PE ratio on a website and say it's low, so that means I need to buy. Because as you can see at the moment, Intel's once value, quote, low PE ratio is now 56 times, like an NVIDIA-like, 56 times forward earnings. I could get on here and told you as we roll through the financials of Intel that it was just going to get worse and worse and worse. I could have an I told you video when I constantly bashed this stock when it was $50, $60 per share and completely crashed down. I could have an I told you so video. And in fact, that is what you are used to hear from the so-called financial community here on YouTube. They get married to a stock. They give it a ring. They tell it vows, and they never, ever think about selling it or changing their mind about the stock. They ride stocks like Tattooed Chef all the way down to bankruptcy and zero and take you, the investor, all the way down with it. We could have that moment with Intel. I could stake my flag and say, never, ever buy Intel. But every time this company reports their earnings, we give it a fresh start and we give it an opportunity to maybe make it back into our portfolio. That is what a real investor does. The rest of these jabronis here on financial YouTube, I honestly have no idea what they're doing other than clickbaiting you into views, likes, and course subscriptions. We better kick things off like we always do with Intel Corporation, ticker symbol INTC. Over the last year, I tell you what, things are looking pretty good. Even though we are down 1.5%, and if you bring up a chart of like NVIDIA over the last year, it's up just 132%. Maybe a little bit more comparable will be an AMD, up 11%. So yes, Intel lagging behind the most high beta names in the chip space, but not far actually behind AMD. The company has just reported their Q2 earnings back on July 27th. Revenue came in at $12.9 billion. That was a decline of 15.7%. Anybody that says this is an AI stock, an AI company, somewhere in these financials, they call it data center and AI. This is not an AI company. They don't have an AI product. Nobody cares about this company from an AI perspective. Now, that doesn't mean that they won't benefit from that longer term trend down the road, but at the current time, this company is not capitalizing on that wave. And to be quite frank, nobody really is outside of NVIDIA. What we did see in the most recent quarter is very encouraging for the company, though, is they're estimating revenue for the third quarter to be between $12.9 billion up to $13.9 billion. The consensus estimates were for $13.28 billion. Now, the thing you need to understand with Intel is the bar has just been dropped lower and lower and lower. It's like a student going off to college and saying, I'm going to get a 4.0 grade point average. And then they make it through a couple of semesters or a couple of weeks in the semester, and they've been partying a little too much. And so they drop it down to a 3.0. And then they party a little bit too much more, and now it's a 2.0. They're just looking to pass. And that's basically where we're at as it relates to Intel. Folks, a year ago, Wall Street was expecting a number for the Q3. Again, I just told you this company is going to do $12.9 to $13.9 billion. And there's probably going to be channels here on YouTube. There's certainly going to be Wall Street analysts as well that are going to be like, oh, look at Intel. It's turned the corner. Just keep in mind, a year ago, Wall Street was expecting $22 billion, nearly $10 billion higher in terms of revenue on a quarterly basis. So the bar has just been shrunk completely down to as low as it possibly can get. When you look at the earnings side, this company was expected to earn over $1 per share. Now Wall Street expecting just 4 cents. That would be an 84% decline year over year on the earnings side. Now, it's not Intel's fault that Wall Street had those high expectations, but it is, well, Intel's fault that they were not able to meet those expectations. We'll come over here to the financials. Have they gotten any better? If you've been watching this channel, you've seen the deterioration in front of your eyes. That is why instead of recording these videos in front of my 2 Teslas out there or my boxes of Rolexes, we shrink me down to the corner of the screen and highlight what actually matters and what actually will make you a great investor and will get you that fancy sports car or that fancy luxury watch, is actually understanding what's going on from a financial perspective. And you, if you've been following Intel's financials, you didn't need me. You didn't need anybody telling you what was going on. It was as clear as day. Year over year, you're still seeing a contraction in revenue. We talked about it at the top. 15.7% year over year decline there. Unfortunately, your cost of sales not driving down either. So margins are absolutely getting shriveled up. Look at your gross margin year over year from $5.6 billion down to $4.6 billion. Unfortunately, your research and development over this company is nearly as much as your gross profit. And then you obviously have selling general administrative costs as well. The company has done finally a nice job kind of shaving those costs year over year. Your operating expenses actually finally down from 6.3 billion down to 5.6. You take 4.6 billion in gross margin, you minus off 5.6 billion in operating expenses, and yeah, you guessed it, you lost $1 billion in the most recent quarter at Intel. Last year, you lost about $700 million. All important inventory line over on the balance sheet, actually looking like it's moving in the right direction. The company is starting to flatten out its inventory. We'll see that when we get to sales as well. The company kind of indicated on the conference call, they're looking at personal computing demand to start to trough, if not maybe recover sometime in 2024. The company does have a fair amount of cash, but coming on down here to the liability side, you're seeing where it's coming from. It's certainly not coming from selling microprocessors and computer chips. In fact, it's coming from the old bank debt side. $37 billion last year, all the way up to $46 billion. I bet you want to check that interest rate. It's probably not low. Now, when you come out here to the cash flows over at Intel, it's not going to be good, guys. 6 months ended, we pulled down a net income loss of $1.3 billion last year. It was a positive $7.7 billion. You add back in stock-based compensation, despite the absolutely disastrous results this company has been putting up. Well, at least the executives are making as much year over year as it relates to stock-based compensation. Your net cash provided by your operating activities, again, this is for 6 months, went from $6.7 billion all the way down to just $1 billion. That's a problem, considering the company is trying to build out these, quote, fabs that everybody keeps talking about. Those are pretty expensive last time I checked. Your additions to property, plant, and equipment at Intel, just $13.3 billion in the most recent 6-month period. So you generated only $1 billion operating the business, and you burned through $13 billion on property, plant, and equipment. Yeah, that's probably not going to be good. So the company had to take on some more long-term debt to the tune of nearly $11 billion in the most recent quarter. They are shedding shares of Mobileye subsidiary as fast as they possibly can as another way to raise fund. And they did the smart thing, in my opinion, and they reduced the dividends that they're paying to shareholders. If, really, ideally, this company would cut the dividend altogether, but they're trying to hold that for whatever reason, or maybe just cut it down to 1 cent so you can remain in some of these dividend funds. But there's no reason why this company should be burning through over $2 billion every 6 months when the results are not supportive of that. But the past is the past when it comes to Intel, and we are seeing some signs of life. Look at your client computing on the desktop side, where this company probably has a better competitive advantage versus certainly maybe a little bit AMD, but certainly Apple as well. $2.3 billion, actually positive growth. I mean, it's basically flat from a rounding perspective, but a little bit positive growth there. Your notebook computing still down as the competition in that space just simply as shipping better products than Intel. They are probably not making a ton of money on that. This company says that they're doing data center and AI. AMD is eating their lunch in the data center. You see year over year, 4.7 down to $4 billion. You need some stabilization there. You got your network and edge from $2 billion down to 1.4. Mobileye and the rest of this stuff, including the foundries that everybody's talking about, is while it has very explosive growth rate from 57 million to 232, that's a rounding error on a company that is worth about $150 billion. Now, the most important thing to realize, though, is they ain't making money on the rest of that stuff. They're making money on client computing, and they did a nice job from we'll call that $7.7 billion in revenue last year down to 6.8, but they actually squeezed out more operating income than they did a year ago. Very nice job from Intel. So if you do have a turnaround, even if these start to go flat and then maybe just inch up at like a single digit rate, the company is illustrating that they can squeeze out more operating income. But you see in the data center, on the network, and in the foundry services, they are losing money despite, in some cases, higher revenue. They continue to churn out profits in Mobileye, but they also continue to sell the stake and interest in that company. Now, forget everything that I just said, because this stock chart is starting to look absolutely sensational. We've got your typical busted growth stock kind of story here, where the stock went on a monster rally and then kind of based out at a high level between $44 and $50. We could pull up other busted growth stocks like PayPal. Tell you what, PayPal looks a hell of a lot similar to Intel, right? This is why I got on a video yesterday with PayPal, and the Jeremy Lefebvre wannabes got in the comment section and said, oh, you got to buy the dip here. You got to buy the dip. No, what you got to wait for is for the stock chart to start looking like Intel. Look what Intel's done more recently. We're making higher highs, higher lows. We're on a weekly chart here. This looks good to me. We do have overhead resistance right about where the stock is right now in kind of the mid 30s. We would expect Intel to take a little bit of a breather at this area, whether it comes all the way down to the bottom channel, which should take you to about $30 per share. More likely you come down into kind of the low 30s on this stock. Now, the growth is still busted. The company's products are not competitive. Literally, they're just not very competitive as it relates to AMD. We can't even mention them in the same sentence in AI as NVIDIA. Of course, you're really not doing that with any company at the current time. At least AMD has something that's coming down the pike in Q4 as it relates to that. So I wouldn't want Intel to kind of retest these lows. You retest these lows, you just more or less, this is kind of a relief rally in a longer rally heading downward. There should be some support down here at 19, maybe even lower at 15. The problem is if you fall off this cliff, you're looking at a single digit stock, and some of you are saying, well, how could that be? Well, the company doesn't make money. They're going to have to, if they don't turn it around quickly, they're going to slash the dividend again. They're going to add more debt to the balance sheet, and it's going to take even longer for this company to generate positive cash flows and generate profits, which is ultimately what investors want. Now, if that time frame is more or less upon us, then yeah, you're buying the dip on this one down into the kind of the low 30s. You have a stop loss somewhere in kind of like 25 or higher, and you're risking like $6 for this one to make a new high, probably back up to this support level here, all the way back up to 43. It's not like the best risk reward setup. You're risking 6 to make like 12. But it's not the worst, and it's a heck of a lot better strategy than some of the crap you guys put in the comments section of my videos as it relates to stocks like PayPal, or even worse, like Square. Intel actually showing some signs of life. It's a busted growth story. It's a busted dividend stock. How do you know when to get back into them? Well, guess what, folks? The stock chart actually tells you, and right now, stock chart's telling you probably should get back into Intel as it continues to move lower. Hopefully, guys, enjoyed today's video. We'll be back again soon with more. Good luck with your investments.